Okay, let's go ahead and take a look at a 2-year example of a consolidation of a partially owned subsidiary where there is other comprehensive income involved. And this is going to be pretty lengthy, I'm afraid. Now, you might wonder why we're going to spend so much time running through a 2-year example of a partially owned subsidiary with other comprehensive income. First, this is going to be critical when we deal with consolidating foreign subsidiaries. When we translate a foreign subsidiary's trial balance, we're going to end up with a translation gain or loss, which will be part of accumulated other comprehensive income. So we're going to have to deal with that later. Secondly, the textbook doesn't deal with multiple year examples, which is something that you really need to be conversant with. And finally, we'll take a look at an alternate organization of the consolidation worksheet. So we have our example. Once again, Big, as always, acquires 70% of Little for $350,000. The fair value of the non-controlling interest on that date is $150,000. Little's book value is $500,000, common stock $100,000, retained earnings $400,000, and all of Little's assets and liabilities have fair values equal to book value, so there's no differential. Neither Little nor Big has any accumulated other comprehensive income on January 1st, 2001. And let's assume that during 2001, the year of acquisition, Little reports $50,000 of regular earnings plus $20,000 of other comprehensive income, and they pay no dividends. During 2002, Little reports earnings of $60,000 plus additional comprehensive income of another $30,000, and again pays no dividends. And of course, what we're going to have to do is A, prepare equity method entries, B, prepare elimination entries, and C, complete the consolidation worksheet. First, for our equity method entries, these will be as before. We make our acquisition, so we debit an investment Little for $350,000. We record our share of the reported earnings, $35,000. And now we also report our share of Little's other comprehensive income. Little had $20,000 of other comprehensive income. We own 70% of Little, so we have $14,000 of other comprehensive income. Then when we do our elimination entries, again, as before, we have our S entry where we eliminate the beginning of year owner's equity accounts, and we close those against the investment in Little and the non-controlling interest. The I for investment income entry, the same as it's always been. We've got $35,000 of investment income, and that needs to be eliminated. Likewise, the income to the non-controlling shareholders, same as it's always been. Little had $50,000 of earnings. The non-controlling shareholders are entitled to 30% of that, or $15,000. And now we have this new entry to deal with the other comprehensive income. So what we're going to need to do is we need to allocate a portion of the other comprehensive income to the non-controlling interest. And again, there's $20,000 of other comprehensive income. The non-controlling shareholders get 30% of that, or $6,000. That $6,000 of other comprehensive income increases the non-controlling interest. Please note the parallel to the INC entry directly above that. Basically, in the INC entry, the non-controlling interest gets their share of the reported earnings. Now they're getting their share of the other comprehensive income. Next, we have to eliminate part of the overall other comprehensive income. As it stands now, Little is reporting $20,000 of other comprehensive income. Big is reporting $14,000 of other comprehensive income. We need to get rid of Big's other comprehensive income, and we close that against the investment in Little account. And again, note the parallel to the I entry here. Up in the I entry, we eliminated Big's investment income of $35,000. Now we're eliminating Big's other comprehensive income from their investment of $14,000. An alternate way of organizing those elimination entries, which I think is much clearer, is again the S entry will be as it was before. Now we're going to go ahead and look at the parallels between the investment income and the other or the ordinary income and the other comprehensive income. So under the I entry, in addition to eliminating the investment income, We're also going to eliminate BIG's other comprehensive income. Similarly, under the Inc. entry, or INC for income to the non-controlling shareholders, we're going to allocate to the non-controlling shareholders both their 30% of the reported earnings plus their 30% of the other comprehensive income. And so again, I like to organize things by topic or by the nature of what we're doing, and so this way we're combining both of the income allocations to the non-controlling shareholders in one section. Again, obviously, if you look at the left-hand side of the screen and the right-hand side of the screen, we're doing the exact same thing. It's just being organized in a slightly different fashion. That OCI entry, which again, that's the way the textbook presents it, that's not very intuitively appealing to me as a way to structure that entry. That's why I like to break it into its component pieces. Half of that entry is for the non-controlling shareholders, the other half is for the controlling shareholders. In any event, let's go ahead and start putting this into our worksheet. So basically the worksheet there, that's simply the trial balance of big and little organized into this worksheet. And you'll note that the worksheet is a little bit different now than it was previously. The top portion is the same as it was before. It's our income statement, revenues less expensive plus investment income, all that stuff is the same. But then directly below that, we put the other comprehensive income statement. And the reason I'm doing it this way is this is how a company's income statement is structured. They have the regular income statement, and then directly below that they have the other comprehensive income. And the two of those combined is referred to as the statement of comprehensive income. So again, we've got this nice parallel structure going on. First our income statement, and then our other comprehensive income statement. Next we have our statement of retained earnings, just like it was before. And then below that we have our statement of accumulated other comprehensive income. Again, firms have two types of income. They have their regular income, which goes to retained earnings. They have their other comprehensive income, which goes to accumulated other comprehensive income. So basically we have what amounts to two income statements and what amounts to two accumulated income statements. And then after that we have our balance sheet, of course, just as it's always been done. Just to contrast quickly with what the textbook does, the Christensen textbook, basically they take that statement of other comprehensive income, the portion from which the upper arrow is leading, and they embed that within the statement of accumulated other comprehensive income. So basically they have beginning accumulated other comprehensive income, then they take their other comprehensive income less the other comprehensive income to the non-controlling interest, and that gives us our ending accumulated other comprehensive income. So they're basically taking those two statements and compressing them into one, and then they take that resulting compressed statement and put that down at the very bottom of the worksheet. Again, it doesn't really matter how you organize these things. Personally, I like, obviously I prefer organizing it so that the income statements are both grouped at the top of the worksheet, the two statements of accumulated earnings are both placed in the middle, and the balance sheet is down there at the bottom. Okay, so let's go ahead and post things to the worksheet the same as we always do. The S entry is posted as it's always been posted. The I entry, and again, we now have this sort of combined I entry with two parts to it. We post that, and again, we need to be a little bit careful here. The first half of that combined entry, the debit to investment income and the credit to investment in little, again, you need to keep in mind, one of those is up in the income statement, one of those is down the balance sheet. The second one, again, we're taking away part of the other comprehensive income in the other comprehensive income statement. And then finally our combined Inc. entry, and obviously those two entries could be combined into a single three-line entry. Again, we allocate the earnings to the non-controlling shareholders just as we've done repeatedly in the past, $15,000. And then we also allocate $6,000 of the other comprehensive income to the non-controlling shareholders. Again, basically the way the allocation of earnings to the non-controlling shareholders is being treated is the same in both of those income statements. We allocate $15,000 of the regular income, we allocate $6,000 of the other comprehensive income. And both of those serve to increase the non-controlling interest. So we add $15,000 to the non-controlling interest, then we add another $6,000 to the non-controlling interest. Let's go ahead and work our way down the big and little columns before we go any further. And again, this is just to illustrate, again, how things aren't changing a whole lot. All we're doing is we're adding another income statement, and we're adding another statement of combined earnings. So as before, we bring down big's earnings down to their statement of retained earnings, and the same for little. To get our ending retained earnings, which we then transfer down to the balance sheet as ending retained earnings. We then do the same thing with our other comprehensive income. Note that almost dead center in the worksheet there's that beginning AOCI, the beginning accumulated other comprehensive income. Recall that our assumption was that neither big nor little had any accumulated other comprehensive income at the beginning of the year. So they both start with zero balances. They had $14,000 and $20,000 respectively. That gets transferred down to their statement of accumulated other comprehensive income, and that becomes their ending AOCI, which then gets transferred down to their balance sheets. $14,000 for big, $20,000 for little. So again, this isn't a great deal more complicated. All we're doing again is adding a separate income statement for the other comprehensive income and a separate statement of accumulated earnings. Okay, let's go ahead and fill in our worksheet in the usual fashion. We add across revenues, expenses, and investment income in the usual fashion. Then to get the consolidated earnings, we once again will add down or subtract down the consolidated column. Of that $150,000 of earnings, $15,000 gets allocated to the non-controlling shareholders, leaving $135,000 for the controlling shareholders. And again, that gets transferred down to the statement of retained earnings right away. Now we need to go through our statement of other comprehensive income. Again, we add across in the usual fashion for the other comprehensive income. Again, we've essentially negated or eliminated big's other comprehensive income, leaving us only with little's balance of $20,000. And then again, we say of that $20,000 of other comprehensive income, $6,000 gets allocated to the non-controlling shareholders, leaving $14,000 for the controlling shareholders. And again, that gets transferred down to the statement of accumulated other comprehensive income. Now we continue in the usual fashion. We work through our statement of retained earnings. So we've eliminated the subsidiaries' beginning retained earnings. And so our ending retained earnings is $635,000. And just as we've always done, we transfer that down to the balance sheet as ending retained earnings. Now we work our way through the accumulated other comprehensive income statement. Again, the beginning balances were zero. We add the $14,000 of other comprehensive income for this year. And so our ending AOCI is $14,000. And that gets transferred down to the balance sheet. And again, on the balance sheet, we present the parent's accumulated other comprehensive income. The total AOCI is $20,000. $14,000 of that is being expressed explicitly as AOCI. The other $6,000 is rolled into the non-controlling interest. Again, the very last line on the worksheet, $6,000 credit to the non-controlling interest, that represents their share of that $20,000 accumulated other comprehensive income. And now we finish out the rest of our balance sheet in the usual fashion. No sense talking our way through that. We've done that multiple times before. Now, of course, in the classroom at this point I say, any questions? But I can't really do that because you can't talk back. Okay, let's go ahead and go on to year 2. And again, we assumed that little had $60,000 of additional earnings plus an additional $30,000 of other comprehensive income. And at this point, you may be asking yourself, why in the world we're going to do another example of what amounts to the same thing? The difference here is that now we have a beginning balance in accumulated other comprehensive income. And so this is where things are going to change a little bit from what we did in year one. And again, this is the part that the textbook fails to address, so it's important to go through it. First, for our equity methods entries, as same as they were last time. Little has $60,000 of reported earnings. Big corporation claims $42,000 or 70% of that. And they also record their share of the other comprehensive income. So again, Little has $30,000 of other comprehensive income. Big has 70% of that, or $21,000. Next, for our elimination entries. Again, the S entry, as always, we eliminate the beginning of year common stock and retained earnings. Retained earnings is now up to $450,000. But in addition, we also eliminate Little's accumulated other comprehensive income. Again, accumulated other comprehensive income is an equity account, and we always eliminate the subsidiary's beginning of year equity accounts. So that account's going to be eliminated just like any other. So the total of those three debits combined is $570,000. That $570,000 gets split 70-30 between the investment and the non-controlling interest. And just as a note, the non-controlling interest of $171,000, that's where we left off last year. That was our end of year balance in the non-controlling interest. So again, the idea is we're sort of reestablishing where we left off at the end of last year. Next, we have our I for investment income, and again, let's go ahead and do both the parent's share of the reported earnings and the parent's share of the other comprehensive income. So first, the I for income entry, we eliminate the parent's investment income, and we also eliminate the other comprehensive income to the parent. And if you look at the equity method entries, basically what we're doing is we're reversing the equity method entries, undoing the investment income, undoing the debits to the investment Little, and undoing that other comprehensive income. Likewise for the I and C entries, the income to the non-controlling shareholders. We will allocate to them both their share of the regular earnings, $18,000, plus their share of the other comprehensive income. Again, $30,000 of other comprehensive income. The non-controlling shareholders get 30% of that, or $9,000. And finally, the textbook entry simply combines our two OCI entries, combines them into a single entry. So the last half of the I entry, the last half of the I and C entry get mushed together into a single entry. And of course, mushed is a technical accounting term for combining entries. Okay, let's go ahead and do our worksheet. Again, those are our elimination entries, and there's our trial balance for the two companies. Note the only, obviously we have different numbers this time, but the only, notable difference here is that now we do have a beginning balance in our accumulated other comprehensive income. And just as when we adjust, in the S entry, when we eliminate the subsidiary's retained earnings, we're eliminating their beginning retained earnings. The same thing applies to that AOCI debit. We're going to be eliminating the subsidiary's beginning of year AOCI. Just a few notes about some of the numbers here. The beginning retained earnings of $635,000 for Big and $450,000 for Little. Those are the ending retained earnings figures from the previous year. The beginning AOCI of $14,000 and $20,000. Those were the end of year balances from the previous year. The other comprehensive income up in the seventh line down in the worksheet, that was given $30,000 was Little's OCI. Big had 70% of that, or $21,000. The investment income, third line down on the worksheet, is what we had via our equity method entries. And then finally, the investment in Little balance of $462,000. Again, you could confirm that by running through your equity method entries. We ended last year at $399,000. We added our share of Little's reported earnings, $42,000, plus we added our share of Little's OCI, or $21,000, taking the investment in Little up to $462,000. Okay, let's go ahead and post our elimination entries to our worksheet. As always, we eliminate beginning retained earnings and common stock. We also eliminate the beginning accumulated other comprehensive income. And we credit the investment in Little and the non-controlling interest. The I entries, again, this is where this is what's new to us a little bit. We're eliminating both the investment income up in the regular income statement, and we're also eliminating BIG's other comprehensive income in the statement of other comprehensive income. And for the sake of conserving space in the worksheet, I simply netted together those two credits to the investment in Little. So a credit to the investment in Little for $63,000. Just real quickly, I keep saying we eliminate BIG's other comprehensive income. We eliminate BIG's other comprehensive income that came from their investment in Little. Obviously, BIG might have their own other comprehensive income from their own transactions. We're not eliminating that. We're simply eliminating the portion that accrued to them from their investment in Little. Finally, we post our two Inc. entries, and again, we basically have two income allocations. We have the income allocation of the regular income up in the income statement, and we also have their allocation of the other comprehensive income in the other comprehensive income statement. And again, let's go ahead and combine those two credits to the non-controlling interest, totaling $27,000. Now, there's no need, I don't think, to go through the entire worksheet. This has already gone on long enough, I think. Let's just focus on the other comprehensive income aspect. Again, we go ahead and add across our other comprehensive income row and the less other comprehensive income to the non-controlling interest. So our other comprehensive income to the controlling interest is $21,000, which we then transfer down to the statement of accumulated other comprehensive income. Beginning accumulated other comprehensive income, again, we've eliminated Little's beginning of year AOCI, so we're left simply with BIG's beginning of year AOCI. We add this year's other comprehensive income. That gives us our ending accumulated other comprehensive income, which we then transfer down to the balance sheet as ending accumulated other comprehensive income. Okay, I believe that's it. Oh, it's not. A couple more things. Okay, please first note that in the statement of other comprehensive income, we are showing both the total other comprehensive income as well as the portion which accrues to the non-controlling interest, finally ending up with the net amount that accrues to the controlling interest. Again, in another presentation, I took a screenshot of the General Electric income statement from 2014, which again showed that they had all the other comprehensive income sources, summed those up, and then deducted out the portion that accrued to the non-controlling shareholders. Again, here we go, just to refresh your memory. This is the GE statement of comprehensive income for the years ended 2012, 2013, and 2014. And again, at the very top, we have basically the end of their regular income statement. They have their net income, less the earnings that attribute to the non-controlling interest, what we refer to as the income of the non-controlling shareholders, leaving us with what we call the income to the controlling interest, what they call the net earnings attributable to the company. And then immediately after that, they list all of the other sources of other comprehensive income. They aggregate those up, so the other comprehensive income or loss is a $9 billion loss. And then of that $9 billion loss, $14 million is allocated to the non-controlling shareholders, leaving $9.05 billion for the controlling shareholders, or attributable to the company. And so finally, the comprehensive income is the sum of the regular income plus or minus the other comprehensive income. So $6.279 billion between their regular earnings and their other comprehensive earnings, Of that 6.279 billion, 98 million accrues to the non-controlling shareholders, leaving 6,181 million for the controlling shareholders. And before I go any further, just let me note that I've finished filling in the balance of the worksheet, basically running through the statement of retained earnings, transferring the ending retained earnings down to the balance sheet, and likewise running through the statement of accumulated other comprehensive income, transferring the ending AOCI figure down to the balance sheet as well. Secondly, note that on the balance sheet, we're reporting only the parent's share of the accumulated other comprehensive income. The non-controlling interests share of that accumulated other comprehensive income is reflected in their non-controlling interest account. Recall that the first year Little had $20,000 of other comprehensive income. The second year they had an additional $30,000 of other comprehensive income. So for the 2 years combined, they've got a cumulative total of $50,000 of other comprehensive income. Big companies reporting their share of that, or 70%, $35,000, as the AOCI on the balance sheet. And now we are done.